Street could a company report a quarter with 39% earnings growth and then have its stock take a 7.5-point hit? Because the results merely match the street's expectations, not overpowering them. And guidance for the future was at the low end of what Wall Street hoped for. That's the ridiculous story about what happened today in Panera Bread, a great company in an industry that's en fuego, with a stock that got hammered for no good reason. Unlike some other dining chains, Panera didn't lower the bar and manufacture an earnings beat, which, dumb as it sounds, is something that turns off a lot of mutual fund investors who happen to love manufactured earnings surprises. But to view this quarter as disappointing, sorry, it's completely and utterly insane. And even if there were reasons to dislike the quarter, that still doesn't mean I think you should sell Panera. We've come out of our garden variety depression as opposed to the garden variety salad that was late today from Panera. That was my staff's fault, though, not Panera. We're seeing signs that a turn in the economy is coming. What? Oh, okay. That's the person who brought the salad late is upset. That could take us out of the current recession. That's fantastic news for the restaurants, even if swine flu turns out to be a legitimate near-term problem. Beyond that, we have the weaker restaurants going under, or just unable to get financing to expand, the only industry that hasn't got TARP money that I follow, which is a great situation for Panera with its pristine balance sheet and all the other winners in the industry because they now face less competition. Who can stand up to these breadsticks or this company's brilliant innovation, the chili bowl made of bread? This, my friends, is the single greatest thing that I eat when I go out. Right here. Even better than the unlimited ROPS. Even better than Oktoberfest. People should be buying Panera hand over fist after the quarter reported last night. And the terrific positive first quarter personal consumption numbers we already covered. They're up 2.2% when the street expected a mere 0.9% increase in the first upturn in personal consumption since the second quarter of 2008. Panera is benefiting from cheap gas prices, makes it less expensive for people to dine out, along with lower commodity costs. Food and paper make up 36% of Panera's total operating costs. Benchmark paper price down 28% year over year. And on the food side, Panera has completely bought out wheat, its most volatile commodity, for the entirety of 2009, locking in a wheat price down 36% versus a year ago. Whenever we look at a fast-growing restaurant chain, we always want to know how much room it has left to grow. Has it saturated the country yet? Or is there still space for more Paneras? Is it a regional chain that's going national? I love those stories. Now, Panera really isn't one. Maybe that's what people are upset about. They think that there's no more room for expansion because it's already in 41 states. But it could be something even better, a concept that works everywhere, but still has a long way to go before it reaches saturation intrastate. As of the end of 2008, Panera has 1,325 units. McDonald's has 13,000 units, 13,918. Burger King, 7,512 units. Brinker, think Chili's, 1,888. And Darden, Kramer Fave, 1,702. That's 1,702. How do I think Panera stacks up to the other fast-growing chains like, say, Chipotle, which everyone loves? Panera does have more locations than Chipotle's 837, but it's much less concentrated. Just take California. Panera's fourth largest market, 81 locations, 122 for Chipotle. Texas, Panera's 10th largest market, 43 locations, Chipotle 78. Right now, I think you are getting a fabulous opportunity. I'm sure there'll be some yokel jokel who will downgrade this thing tomorrow because the chart's broken. I think you get a chance to buy the broken stock of a clearly unbroken company with Panera right now. It's a restaurant chain with turbocharged growth that's proven itself all across America and still has room to grow. But we like to do our homework on this show, and maybe I'm all washed up. Maybe I'm no different than a piece of bread that is just, well, let's just say, sagging. I don't know. Let's hear from Panera's terrific chairman, co-founder, CEO, Ron Shaich. Mr. Shaich, welcome back to Mad Money.
Hey, Jim. How are things in New Jersey?
Mr. Shaich, I think your stock didn't get a fair shake, honestly, today. And you've met or beaten consensus 7 straight times. How come you didn't get any credit for your number today?
We hit our guidance. We held our guidance for the rest of the year. The reality is this stock, Jim, was up 50% last year. It's been up in the range of 20% year to date. I think the measure for a company is not its stock and its change in its stock on a given day, a given week, or a month, but the performance that occurs over a long period of time, a year, 5 years, and 10.
Couldn't agree more, which is why your stock has been on my list of things to buy, because all the others have really faltered during this period when you've done great.
Yeah, we've had a great run. We continue to have a great run. The fundamentals are good. This was a quarter up 39%.
I sit here and I think one of the reasons why running a public company is such a bear, something you don't want to do, is when you deliver spectacular numbers and your stock goes down. It's very difficult to try to justify all the hard work you put in.
Yeah, hey, listen, I've been CEO of a public company for 18 years. I'm the Cal Ripken of earnings releases, 72 straight quarterly earnings releases. So it goes up, it goes down. The key for us is to deliver the goods and keep focused on the customer.
There's not an Oriole fan in the room, so I think you really lost us with that. But, if you had said maybe the, I don't know, Santana? The Santana? Okay, anyway.
Hey, listen, I live in Boston now.
Look, what can I do? What can I do? I know we have a good series coming up. A fabulous game on Saturday. All right, now one thing, when I parse out the quarter, your guidance for new unit average weekly sales for Q2, now full year are 36,000 to 38,000, even though this quarter, new unit average weekly sales were 41,000. That sounds like you're being conservative to me.
Well, I think our responsibility to the street and all investors is to guide fairly and then do everything in our power to beat it. And I think that we had an extraordinarily strong series of openings in this first quarter, and I don't want anyone out there to assume that's going to continue for the full year. So we guide to a very real number, 36,000 to 38,000, delivering a very high 40% cash-on-cash return on investment. But we don't want to pump the stock. What we want to do is deliver over the long term.
Well, I think that that's perfect. I do know that there were chartists out there who felt that the stock had broken. We often I don't say we ridicule chartists, but they often give us our best opportunities to get in stocks. That's what I felt happened today to you guys. How about this? Competition changing? People catching on to your strategy? Maybe that's no?
No. I mean, we've had the same strategy for 15 years. We haven't evolved it, haven't changed it. We've stayed focused on delivering against our vision of real food served by engaging people in environments that excite people, rooted in this artisan bread. I will tell you that none of the things that really matter to a company change in a week or a month or a quarter. The reality is the things that I'm focused on are the things that will affect 2010, 2011, and 2012. And if we do our jobs right, we will continue to grow and continue to develop. And if we do that, this stock will take care of itself.
Totally agree. I see you brought on some head of merchandising from Godiva, senior person from Borders. I remember speaking with the management of Starbucks when they started getting, they put in a couple of them in a Barnes & Noble. Next thing we know, we had the next leg of expansion. Godiva, Borders, anything going?
Oh, I don't think you should expect to see a Panera buried in the Borders or in a Godiva, since a Godiva is materially smaller.
Right.
I think the reality for Panera is we have a great concept. This dog hunts. It works everywhere in this country. We have the highest average unit volumes of anybody within outside of casual dining. A very high return on investment. There's a lot of opportunity for Panera. Our most dense markets is like the central Midwest of the United States. If you extrapolate out that, there's a lot of stores in this country for Panera to grow. The question is, can we keep up with the demand?
Because you're from Livingston, I've got a couple of malls nearby, more vacancies than I've seen, including high-end malls like the Short Hills Mall. Opportunity to be in malls where I think that, Au Bon Pain is and does pretty well.
Yes. Well, as you know, I co-founded Au Bon Pain.
Right.
The reality is that Panera doesn't want to be dependent on that center. One of our great successes is we have not been dependent on those malls. The reality is that for us, we're happy to do mall locations when we have external entrances and we can draw our own customers.
Oh, right. You can't.
Right.
That's right. Other than Legal Seafood, there isn't anyone. Boy, yeah, you're absolutely right. You do not have external entrances in the malls that I know. It's not worth doing. Ron Shaich, you're terrific. Thank you so much for coming on the show.
Jim, take care of yourself.
Okay. Look, guys.